A man walks into a bank on a Tuesday to open an account for his new company. His passport is genuine. His address is genuine. The company is genuinely registered, 3 weeks old, every fee paid. Every check passes, and 2 floors up, a woman he will never meet stops the account from opening. By the end, you will know the 2 questions she is actually asking, why the second one has no answer on any document he brought, and the 3 moments where this job stops being paperwork. Her job title says KYC, Know Your Customer. The law never uses that phrase. The legal term is customer due diligence, and the difference is not pedantry. Knowing someone sounds like checking a document. Due diligence means you are on the hook for what you concluded. So underneath the whole job sits one root question, not is this person real? Who is actually behind this? Step 1 is identity, and it is the easy part. Europe's rulebook gives the bank 2 routes, and that is the whole menu. Video identification is not in the regulation at all. In Germany, it still runs on a BaFin circular from 2017 that the regulator itself calls a bridge technology. 8 years on, the ordinance meant to replace that bridge is still a draft. Here is what a smart, busy banker assumes at this point. Passport genuine, address genuine, company registered, customer verified, move on. And that is wrong in a way that is very easy to miss. Verifying identity proves exactly one thing, that the document is real and the man standing there matches it. It never proves he is the reason the account exists. He passed every test the document could set. He was never the subject of the second test. The rulebook does not ask one question about a company. It asks 2 in parallel. Who owns it? And separately, who controls it? Read that line again, independently of and in parallel to. Control is not a tiebreaker you reach for when ownership is unclear. It is its own test, running at the same time, which means a man with 0 shares can be the beneficial owner. That is not a loophole. That is the rule. The ownership half has a number, 25% or more, and you are a beneficial owner. That wording is new, and almost nobody notices it. The old directive said more than 25%, so a person holding exactly a quarter was nobody. From July 2027, that person is somebody. And you will read that the new rules drop the line to 15. They do not. There is a power to look at 15 by 2029, and that is all. So back to our man in the branch. His file says he holds 10%. Under the ownership test, he is nobody. The rest sits with a holding company 2 countries away. But the analyst keeps pulling the thread. He appoints the directors, he can veto a decision nobody else can veto. He decides where the profit goes. The rulebook has a name for that, control via other means, and it lists exactly this, including nominee arrangements, formal or informal. The obvious question, why does she not just look it up? Europe has beneficial ownership registers, and she can look. Banks always could. A court ruling in 2022 shut the general public out, but never the banks. Here is the problem. The register is not evidence. It is a form somebody filled in about themselves. If what she finds does not match it, she has to report the discrepancy. The register is not her answer. It is a claim she has to test. She runs the name of the real controller through screening, and it hits. He is a politically exposed person. Now here's the thing almost everybody gets wrong. A hit does not mean no. It has never meant no. It means 3 things. Senior management has to approve the relationship. The bank has to establish where his money came from and where his wealth came from. And the monitoring gets tighter permanently. The decision leaves the analyst's desk and goes up, not a rejection, an escalation. Source of funds and source of wealth sound like the same thing. They are not, and the gap is where the work lives. Source of funds is where this money came from, the wire, the sale, the account it sat in. Source of wealth is how he got rich in the first place. The rulebook wants both, and not only for the customer, for the beneficial owners too. Then there is the news. Nowhere does the regulation say search the news. It says you must understand your customer's risk. Every supervisor in Europe reads that the same way. And then the file does not close. It never closes. From July 2027, the clock becomes law. Higher risk customers get reviewed at least once a year. Everyone else, at least once every 5. Those are ceilings, not schedules. A maximum you may not exceed, not a cycle you tick. If something changes on a Tuesday, Tuesday is the review date. Most of this job is not onboarding anyone. It is rechecking people the bank onboarded years ago. So where does AI walk into this? First, at the door. The selfie you take against your passport photo is a machine deciding whether your face matches. And here is the counterintuitive part. Under the EU AI Act, that is not a high-risk system. One-to-one verification where the sole purpose is confirming you are who you claim to be is carved out. But say those words carefully. One-to-one. Check a face against a database of known fraudsters, and that is one-to-many. That is identification, not verification, and it lands straight back in high risk. Second, at the flood. Screening a name against the global list is not really a search. It is a guess at scale. Most of what it flags is a coincidence of spelling, and a human being opens every single one. That cue is what AI is genuinely for here. Not a smarter alarm, a smaller pile. Third, the attack. You will see enormous numbers about deepfakes beating identity checks. Look at who published them. It is almost always a company selling deepfake detection, counting its own traffic. Europol says it flatter, and without a percentage. Generative AI has lowered the barrier to identity crime. The vendors will sell you a number. Europol will not. So what happened to the man in the branch? His passport was real. His address was real. His company was real. And he was holding it for somebody else. The analyst never proved he was a criminal. She did not have to. She proved she could not answer the second question. And the rule is blunt. If you cannot finish these checks, you do not open the account. That is what a KYC analyst actually does. She is not a document checker. She is the person who has to name a human being and say why she believes it. So steal her question. Not, is this real? Who is behind it? If this was useful, the Reg AI Brief newsletter is where it goes deeper, and it is free. Link below. This is educational only, not legal or financial advice, and the man in the branch is an illustrative example, not a real case. Sources are in the description. Stay sharp.